we would like to talk a little bit about the USA. The United States boasts the world's largest and most dynamic economy, driven by innovation, a strong commercial base, and deep financial market. With a GDP expanding $25 trillion, the US plays a central role in global trade, technology, and investment. Key sectors like technology, healthcare, finance, and manufacturing contribute significantly to its growth. While the dollar's status as the world's primary reserve currency reinforces its economic influence. So the monetary policy in the US is managed by the Fed, which is a Federal Reserve. It aims to maintain price stability, maximize employment, and moderate long-term interest rate. The Fed uses tools such as interest rate adjustment, open market operation, and reserve requirements to control inflation and stimulate economic activity. So how does this monetary policy worked during the COVID-19 pandemic until now? Let's break it down. By June 2020, the COVID-19 pandemic has thrown the U.S. economy into crisis. Business shut down, millions jobs lost, and GDP was on track for its worst drop since the Great Depression, nearly 40%. Unemployment hit 14.7% and is at the highest level in decades, with low-income and minority workers hit hardest. At the same time, inflation crashed to just 0.5% because people weren't spending, and oil price collapsed. The stock market swung widely, plunging in March and then bouncing back after the government stepped in. Washington and the Fed respond with massive relief effort. The Fed cut interest rate to zero and pumped trillions into economy by buying bonds. Congress passed $2 trillion CARES Act, spending stimulus check and boosting unemployment benefit. They also helping small business to stay afloat. But the recovery was from certain. The Fed promised to keep supporting the economy, but with so many small businesses struggling and jobs slow to return, the road ahead looked really rocky. The pandemic showed that how fragile the economy could be and how far little would go to protect it. The response was unprecedented, and the Fed splashed rate to near zero and launched emergency program, buying trillions in treasury and mortgage-backed security to calm the markets. Congress passed the $2 trillion CARES Act, funding stimulus check, small business loan, and expanded unemployment benefit. Despite this effort, the outlook remained grim. The Fed vowed to certain support but risk loom, especially for small business and long-term unemployment. While policymakers awaited total collapse to path to recovery was uncertain, taking on pandemic course, the crisis was underscore how quickly a health shock could destabilize the global economy and how aggressive intervention became the new playbook. And how is it gonna keep going in 2021? Let's move on.
Now turning to the first half of 2021, the U.S. economy saw robust growth during reopening through faced labor shortage and inflation. I will examine how the Fed's policy addressed these challenges to support recovery. There were three critical issues emerged to begin with the labor market. The labor market showed only partial recovery. By June, unemployment had declined to 5.9%, but the labor force participation stayed depressed, with many workers still sidelined, and industries like manufacturing and hospitality faced particularly serve hiring difficulties. Second, supply chain bottleneck from semiconductor to lumber created widespread shortages. These conditions combined with resurgent consumer demand put a PCE inflation rate to 3.9% year-over-year in May. The Federal Reserve responded with unwavering accommodation. They maintained the federal fund rate near zero and continued quantitative easing at 80 billion Treasury security plus 40 billion in mortgage-backed security monthly. Their forward guidance was clear that rate would stay at zero until achieving maximum employment and sustain 2% inflation, with its lifted tolerance for temporary overshooting. Chair Powell emphasized this inflation spike was likely transitory, stemming from pandemic specific supply-demand mismatches rather than economic overheating. This pattern approach aimed to support full labor market recovery while monitoring risk. To sum up, the first half of 2021 was strong but uneven growth, constrained by labor shortage and temporary inflation. The Fed maintained aggressive support while monitoring developments.
Following Cẩm Tú, I will take over the U.S. economic and financial overview from now on. First half 2022, high U.S. inflation above 2% due to supply or demand, energy or food costs, and a tight labor market, low 3.6% unemployment, rapid wage growth. Despite a slight Q1 dip, spending and investment were strong, with moderate Q2 growth expected. Global recovery faced headwinds from the Russia-Ukraine war and China's lockdowns. As for the monetary policy, the FOMC started tightening in late 2021 to fight inflation and the tight labor market. They raised rates to 1.5% to 1.75% by June 2022 and signaled more hikes. As the businesses added in early March and balances reduction began in June, impact tightening increased borrowing costs, worsened financial conditions. Financing slow, but the U.S. financial system stayed stable. The FOMC were committed to restoring price stability for a strong labor market, but the full impact would take time. In conclusion, the U.S. economy faced high inflation and a tight labor market in the first half of 2022. Despite strong spending, the FOMC responded with rate hikes and balances reduction to restore price stability. The full effect will take time. So that the U.S. economic and monetary in the first half of 2022. Now, Ms. Anh will highlight the June 2023 Monetary Policy Report to show 2023 development. Thank you.
Monetary Policy Report June 17, 2023. Although inflation has eased somewhat since mid-2022, it remains well above the Federal Reserve 2% target. The labor market is still very tight, with strong job growth and low unemployment. Despite signs of slowing wage increasing and declining job opening, real GDP growth were modest in the first quarter. In response, the Federal Open Market Committee (FOMC) raised interest rate by 75 basis points this year, bringing the federal fund rate to 5.25% and continue reducing its holding of Treasury and mortgage-backed security, tightening financial conditions further. The Federal Reserve recognized that high inflation caused significant hardships, especially for low-income individuals, and remained firmly committed to restoring inflation to the 2% goal. Inflation, consumer price inflation had been 4.4% in April, down from a peak of 7% in June of the previous year, but still above the 2% target. Core PCE inflation has been 4.7%, with inflation in core survive, especially housing, remaining high. Longer-term inflation expectation has remained stable, suggesting high inflation has not become entrenched. Labor markets. The labor market has remained tight, with job gain averaging 314,000 permanent and the unemployment rate near historical low. Labor demand has especially to labor supply and improved due to immigration and higher participation from prime workers. Wage growth has low but remained above level consistent with 2% inflation. Economic activity. After a strong recovery in 2021, economic growth has slowed in 2022 and growth in the first quarter in 2023 has been modest. Consumer spending has moderated as financing tight and confidence remains low. Business investment has continued to slow and the housing sector has contracted to due high mortgage rate. To some indications suggest it were nearing a bottom. Financial condition. Financial condition has tightened further with a 75 basis point rate increase by the Federal Reserve. Business loans has grown more slowly and banks has tightened lending standard. Consumer loans has continued to rise, but mortgage origination has remained weak. Financial stability. The banking system has remained sound despite concern over some banks' profitability. Corporate security markets has remained stable. To real estate valuation pressure remains elevated. Vulnerability in the banking sector has emerged, leading to the failure of 3 domestic banks. International development. Global economic activity has rebounded in early 2023, driven by China recovery and Europe resilience. Despite energy shock, foreign inflation has fallen, mostly due to lower energy price, but food and car inflation has remained high. several foreign central banks has continued tighten monetary policy, where the US dollar has weakened slightly.
And next, I will present the U.S. monetary policy in 2024 and the first 2 months of 2025. This is a period of stability and inflation control. Over the past 2 years, economies have made significant progress toward the Federal Reserve 2% inflation target and labor market conditions have cooled while remaining robust. Reflecting this development, the risk in achieving the employment and inflation goal are now better balanced. The first U.S. economic stayed inflation decreased in 2023 and modestly declined further in 2024, but remained above the Federal Reserve 2% target. The labor market remained robust with steady job growth and low unemployment, while real GDP growth in early 2024 was moderate but supported by stable revised domestic demand. The second monetary policy July 2023, the FOMC maintained an interest rate at 5.55 to 5.5%. They intend to lower rates only after steady inflation progress. The Federal Reserve reduced asset holding by $1.7 trillion shy by 2022 to ensure stability while maintaining sufficient reserves. The third monetary policy in the first 2 months of 2025, inflation remained above target but showed improvement. The labor market continued to thrive, driving modest GDP growth. In late 2024, the FOMC lowered policy rate to 4.55 to 4.5%, reflecting Earth's labor market ratio and inflation forecast. Asset reduction include Treasury and Treasury security. The finally in inclusion in 2024, the U.S. economy displayed resilience with controlled inflation, a strong labor market, and stable growth. By early 2025, recovery continued with statistic FOMC policy pricing inflation control and stability.
Okay, to summarize all information, the U.S. economy recovered from the 2020 pandemic collapse to stable growth by 2025. The Fed's aggressive rate hike curve peak inflation of 7% in June 2022 without a recession, achieving a soft landing. Resilient labor markets and steady GDP growth by 2025 confirm the effectiveness of the Fed's data-driven, flexible monetary policy amid volatility. Thank you for listening.